view of where the technicals and where the charts and where life in Dubai is headed. Let's start with the latter one, right? That is more important. Markets, nothing is happening.
Good morning, Nikunj. Well, a lot's happening in the markets. Given all that's we've transpired over the last few weeks, I think it's quite incredible. We should talk about it.
We've seen a market where a lot of sectoral rotation has started. Defense, railways, they've already started reversing. PSUs are losing that momentum and gusto. PSU is a leadership sector. And if this sector is now suddenly showing signs of fatigue or reversing, what does that mean for the bull market?
Yeah, I think that's a good point, but I don't think that's the right way to approach the markets because we've seen this frantic sector rotation for the last 3 years, wherein for about 6, 8 months you have certain pockets of the market doing well, and then it just hands over the leadership to other pockets in the market. And look at what pharma has done, look at what IT has done in the last 2.5 months. On the other hand, sectors like capital goods, auto, real estate, PSU have just gone quiet. So this is the best form of bull market that you can actually have. And if you actually look at the data of the last couple of months, the Indian markets have really climbed a wall of worry. I mean, you had those two big local developments that were digested beautifully, and you had those big global developments early this month, wherein there were talks about recession in the US and the yen carry trade and what happened to the Japanese market. And the markets digested all of that with just a 4% dip. So the manner in which Indian indices are handling difficult news flow, I think is quite commendable. And it just tells me that even at current levels, we are good for more. The market is as steady as it can get on the charts. And I think from a levels perspective, I think the next stop is really around 25,500 and then possibly substantially higher over the next 3 to 4 months. So we remain extremely positive. I think this is a market where you need to be in the right pockets until support levels are safe in the form of 24,400, 500. I think we are good for the next few months at least.
Gautam, how can we deny the importance and significance of the mid and small caps? Can't only take a check on the Nifty and not figure out whether the mid and the small cap indexes as well will continue to scale all-time highs.
Yeah, it's incredible, Aisha, because I think I have seen 2017 and I've also seen the 2003, 2007 bull market. And mid caps or small caps are known to be in gear 4 and gear 5 all the time. But if you actually look at how they have behaved in the last couple of years, they've changed gears from time to time. So every time they've turned overbought, they've just gone sideways. And this happened in the early part of this month as well. And it's the top quality mid caps and small caps that are coming back strongly. Let's not forget, it's never happened in the history of the Indian markets that mid caps and small caps are seeing serious amount of sticky money coming in every single month. That's changed the game completely. And that's probably the reason you can't look at the lens of history to understand the mid cap rally and the small cap rally today. And even now, yes, there are pockets where the valuation is out of whack. But if you look at the top 100 in the mid caps and the small caps, I think there is still a lot of room on the upside. For example, there is no substitute to an Indigo. There is no substitute to an Indian hotels. There is no substitute to some of these insurance companies. So I feel that quality mid caps and small caps will continue to run. And this is still not the time to take serious profits.
So let's look at some Tata group of names. Since you mentioned Indian hotels, I'll add Trent. Kunal and me in a studio, when we have a chat about Trent, he says that this is not overbought. This is not extremely overbought. It is extremely overbought where RSIs are above 100. The same could be attributed for a lot of other stocks. Why is that these stocks are sustaining at these levels?
I think it's all about momentum. I mean, if you look at valuations, there is no way you can justify it where a stock like Trent is trading, no doubt about it. And the market is looking too much into the future. But then nobody is forcing you to be active or to take bets on a stock like Trent. And in fact, we've just stayed away from it in the last 3, 4 months because I think it's extremely overdone. But if somebody has bought in at lower levels, say over the last few years, the best way to ride these mega trends, is using a trailing stop loss, using a moving average. For that matter, even if you look at Zomato, there is no way you can justify today's prices based on valuation. And given the fact that it's been a five bagger for a lot of us in the last a couple of years. But I think you just have to ride the momentum, and I think the market is clearly looking at the next 5 years and trying to discount it. So stay with slightly better valued stocks. I mean, look at the NBFC space. I think it's probably one of the better risk rewards. And if the interest rate cycle were to reverse, which is likely to happen over the next 6 months, I think financial services and NBFCs could be the darling of the market over the next 6 to 12 months. So that's the pocket which I am focusing on right now.
Quite interesting. And Gautam can't help probe a little bit more about what are the stocks which are looking interesting within this particular segment.
Well, if you look at the bank nifty, I think it's not done as well. I mean, every day there are talks that the bank nifty needs to participate, but it hasn't. But if you look at the NSE Financial Services Index, which has the banks, the NBFCs, and the insurance companies, they've actually done quite well. And insurance is a pocket that we have been liking for a very long time. And I think the comeback of stocks like ICICI GI, SDFC Life, I think is quite fabulous. And I think there is more to go because this comes after almost 3 years of underperformance. Let's also not forget the NBFC space, and I think the Bajaj Finance and the Bajaj Finservs of the world. I think if you look at the P chart, what you'll realize that earnings have been steady and the Ps have gradually come off in the last couple of years. I mean, if you look at the PE of Bajaj Finance right now, it's at 27, and it was a 55 when it was in its best days. I think a couple of years back. So just going by that logic, I think risk reward tells you that there are various pockets in the market that could do well. NBFCs being one, ITC probably being one of the bigger stories, some of the metal stocks, some of the pharma companies like Dr. Reddy, Cipla, Sun Pharma. I think this is where our focus area is, and I don't think you need to chase the winners anymore.
Where do you stand then when it comes to the banking space? Because we have seen that outperformance in particular for the private banks that has been evident. Your view is that this continues or it's going to be consolidation?
See, you don't ever see a market top without a froth in the large caps or the bank nifty. I think it's never happened in the last 20, 25 years, at least till the time I started looking at markets and started looking at the charts. If you look at the last 3 months, the bank nifty is still around levels of 51,000. Stocks like SDFC Bank, SBI have been consolidating. And I think a breakout in the bank nifty is coming. And I think the numbers are very clear, 51, 200, 300. We are at the doors of that number. And if that zone were to get crossed, you could see the bank nifty move towards a level of 53,500 and eventually 55,000. So I think the risk reward justifies longs into some of the top banks. So I'm still not going grade 2, grade 3. I'm still very, very comfortable with ICICI, SDFC, and SBI. And I think they will be the poster boys over the next 6 to 12 months.
Is the tide ready for, has the tide in a sense changed for IT? Do we have decisive evidence that IT now is not only bottomed out, but it is getting ready for not a rise but a rally?
Well, it's already at lifetime highs, Nikunj. I think it's already done very well in the last 3 months, and I think there is more to come because there was this debate whether AI and the volatility in some of the Nasdaq companies will it going to impact IT companies. I think that has got shrugged off. All the negatives have been discounted. The way the Nasdaq index has come back in the last 1 month, 2,000-point rally from the recent lows, I think is quite commendable. And therefore, the IT index in India is also back. And I think there is more to go. I wouldn't be surprised if the IT index appreciates by about 12 to 15% from here. I'm actually batting for a 1,000 rupee move on TCS. And if that were to happen, it will single-handedly take the IT index and the entire market up. So IT is clearly a favored area. The ratio charts are in good shape, and select mid-cap IT stocks also are looking pretty good on the charts after a long time. In mid-cap IT, you have a basket which is extremely overvalued, and you have a basket which is fairly valued. So that's the kind of basket which I'm looking at.
Gautam, a lot of question marks being raised about how sustainable is the move in autos. While they've had a great run from the COVID lows up until now, but it's getting a little question mark because the fundamentals as well are getting a little bit wobbly. And of course, a lot of transition is really happening within the sector from EVs to hybrids to CNG bikes when it comes to two-wheeler space and what have you. And plus the stocks as well have run their course. But do you believe that there is further headroom? And if there is some consolidation or dip, should autos be bought into then?
I think they have run their course for now. I think the market is discounting too much into the future too fast. And that's what really happened with a Maruti or a Bajaj Auto, a Hero Moto, M&M, or even a Tata Motors, which was a very clear proxy to the entire EV theme. And if you look at the charts over the last 4 months, the auto index has actually been quite sideways. It's been in a sort of a range while indices and some of the other sectors in the market have done well. And I think in every bull market, at every point of time, you have to understand risk reward. I don't think this is a good time for bets in the auto space or the capital goods space based on risk reward, because any market correction and some of these names can correct quite a bit. And even if you study the ratio charts versus the Nifty, you will see that they have all completed their cycle. So I'm not a big fan of auto anymore. I was a couple of years back, but I think they need a lot more consolidation before they can go up further.
Fiery run-up that we saw in some of those PSUs, the defense stocks, etc. Do you think that now a cool-off is evident or par for course?
I think the cool off is happening as we speak. Again, if you look at the PSU index, it's not made a new high. It's not moving with the Nifty. And as the Nifty is at 25,000, the PSU index is actually languishing at the lows. That's been the case for the last 4 months. And I think this was needed because many stocks moved up 2x, 3x in a matter of 1 year. Too much of the positives were discounted. PSUs are still cheap, so I don't think the structural trend ends, but at least the seasonal momentum-based trend which was there, I think that's finished for now, and I don't think it's going to resume over the next couple of months. So this is the time for newer sectors, and I still feel that metals could be the dark horse candidate for the next 6 to 12 months, followed by NBFCs and banks, and clearly chemicals. So I'm actually looking at newer sectors to play the market rally from here.
All right, good. Appreciate your time and thank you for joining us with your inputs.
Thank you.
If you like this video, then like, share and subscribe to ET Now.